Hello, welcome back guys. In this video we are taking a look at Warner Bros. Discovery. Now this is a company that resulted after a spin-off. In case you are not aware, you can kinda quickly see that here Warner Bros. Discovery started trading as a separate company on April 11, a merger of Discovery and Warner Media, which is a spin-off from AT&T. And now when this happens, and when this actually happened pretty much and completed, some things changed. For instance, some debt was offloaded from AT&T to this new entity. And so we're looking at a much higher debt that basically happened during the last quarter. And this is something that you need to know because it may be not reflected in the previous financials that the company has been generating. So we will talk about all this in this video, of course, and examine whether the company is still a buy. Now, it's interesting to see that the company has dropped a lot, like 60%. It had a little bit of a rise when the spin-off was announced, but then it went down again. And right now, again, if you take a look at the one-year chart, it has been going down and down. It's an entertainment industry company, a lot of very well-known channels over here and networks, I should say. If you take a look at our company profile here in our company analysis page, you will see that they have like Discovery, Food Network, Animal Planet, and all these very well-known networks over here. Let's just go back and examine the core financials though. If you take a look at the P ratio of the company, it has been dropping a little bit, and the price to free cash flow has been increasing because there have been some struggles lately compared to the price to the free cash flow that the company has been generating pretty much has been a little bit higher than before is the thing. Now this is still not high. A 12.7 price to free cash flow ratio is definitely not high here. Of course the outstanding shares count is going to be high. That's because of the merger, so this doesn't concern me at all. This is normal over here in this situation. And in terms of the liabilities of the company, you are looking at an 8.67 here. But again, I'm going to be talking about some finer details because the spin-off happened last quarter and some things have changed for the company. We will examine that. Now, the 5-year revenue growth, 77%, net income growth, 400% over here, free cash flow growth at 62%, and total equity growth at 166. Remember, this is almost like a new IPO though, so this is pretty much almost like a new company here, which has a lot of different things that are going to be affected in the upcoming quarters. So buying this one has inherently some risk because there are some new operations to see, some new things to see here that haven't happened yet. And one of the ways to kind of take a little bit of a look at what is going on right now is taking a look at the quarterly periods, in which you can see that the revenue has been increased here in Q2. And for instance, you will see that the net income has been going down because of a lot of depreciation and amortization happening over here. So there's a little bit of a change here. And again, we just have too few quarters to judge about what is going to be happening in the upcoming ones. But, we're looking at much higher, for instance, depreciation, amortization here. We're looking at a company that is creating content, is amortizing a lot of content, and you are likely going to be seeing some negative net income quarters. So bear that in mind. This is a different company, and remember that AT&T stockholders are actually buying the company for dividends. Now this one is more like a growth company right now, so it's not really having any dividends anymore pretty much, and you're looking at the net income going down again because of the merger pretty much. And so this is a different case. And frankly speaking, I just don't think we have a lot of metrics yet about this new entity yet again. But we do know what has been happening before that is the thing. Now, is that reflective? Probably not. It's still worth examining, but take that with a grain of salt. We need more data about the Warner Bros. Discovery merger just to see what is going to be happening in the upcoming quarters, pretty much in the upcoming years. So it may be wise to actually hold off on potentially buying this one. I'm still going to take you through our stock evaluation tool and everything, but again, remember that the company has changed substantially. Now, again, also, if you take a look at the balance sheet, for instance, you will see that the company in the previous fiscal years has been doing rather nice, total equity that has been growing. And if you take a look at, again, the quarterly over here, and you will see that things are changing a little bit over here. And one of the important things is the debt. Take a look at this one. The total debt previously was 14 billion. Right now, there is, after the merger, 53 over here. And in terms of total liabilities, almost 90 billion. So the total debt being 53 almost billion here is actually more than the market cap of the company. It's almost double the market cap of the company. Again, you can find the market cap by going to our metrics page. So yeah, if you go here, you'll see that it's about 30 billion. So again, things have changed substantially for this company, and yeah, you can kind of easily get fooled and think that this is the same entity as before, but it's not really. And again, you will see that the net income of the company has been growing, but if you take a look at the quarterly, you are looking at the recent quarter kind of being worse than what you potentially would want it to be over here. Now, the cash flow of the company, again, in the previous quarters has been doing, or years, I should say, has been doing nicely. If you take a look at the quarters here, you will see that it's still doing nicely, but remember that the reason for this one is the depreciation and amortization effect. This is what we are seeing from our recent quarter, and the net income was actually much lower. It was actually in the negative, and it's just the depreciation amortization expenses here. So we do know that the company has a lot of amortization expenses here, and this is why we're looking at a much negative net income for the quarter. Again, a much different company, almost Netflix-like over here is what I'm saying. So be a little bit careful about this one. Quite significant changes in working capital as well, spending quite a ton of cash flow over here. Okay, if we again, we can take a look at the stock evaluation tool, which will show us historically what the company has been doing and what is projected to be doing. But again, we're looking at a different company that could be growing more, but could be having extra costs. So I will have to go just super conservative here, because again, it's risky. I don't know what's going to be happening in the upcoming quarters or years for the company. Ideally, I would want to wait, and I'm pretty sure we're going to get good numbers here, but there's, again, the reasons that I explained for this. There are the reasons that the company is pretty much a new entity here, and we kind of would want to see what's happening. And I wouldn't be too affected by, in this case, of course, by a stock evaluation tool. It can give me an idea, but it wouldn't affect me too much, is what I'm saying. It generally affects me a lot, but in this case, again, for the reasons I explained, this is what I would think. Now, if we go, let's just say, let's go 3, 5, and 7, and the net income margins. Now, this could be in the negative as well. It looks like we are potentially opening up ourselves to a trend of negative net income margins, as we examined for the latest quarters. So this could be in the negative, but for the sake of the argument, I'm just going to go with maybe the lowest here, or I should say the 5-year average, and a little bit lower, like 3, 5, 7. The free cash flow margins, I'm gonna go with a typical thing, 80, 90, and 100, and an annual return of 13%. Potentially could ask more. Actually, I will ask for 15 for this one. Again, almost a new entity, more risk. I want to be getting some more money. And again, I'm going super conservative, and actually, I rely on the previous financials here. And in this case, you are looking at a red if you go that conservative, and this could be, frankly speaking, a balanced way of approaching this, to tell you the truth. Again, because of what we are seeing with the recent merger and a lot of uncertainty on what the company will be doing in the upcoming years. So I would, while I do like what the company has been doing, we have to potentially wait it out a little bit. That's what I would probably do myself. Now, again, remember, this is pretty much becoming a growth company which has some debt offloaded to them. And so you are looking at a lot of investors fleeing the ship, because again, AT&T investors will not be liking this growth stuff. They are in for the dividends for the most part. And also the fact that we have a lot of debt, and we do really aim for a company that will become a hit, almost like a Netflix type company, which will be spending a lot in productions. So we are potentially looking at this company having a lot of negative net income and a lot of debt pretty much through the years. And so this is something that could really not be great for a new stockholder, to tell you the truth. And I myself, I would probably avoid this one for a while. Again, at least till we have some extra information. Maybe next year or so, maybe we'll have some more data to judge with. Because what is happening right now, again, remember we talked about this one. This is a merger of Discovery and Warner Media, which is a spinoff from AT&T. This is a way to offload debt as well. And so while AT&T could be doing better because of that, and I think the company stock price actually soared when the news happened for the spin-off, it may not be great for a company like Warner Bros. Discovery here. Again, it's a matter of preference, but take these things in mind and decide for yourself, of course. I think I would be waiting for a while just to see how this turns out. But thank you for watching. Remember to leave a like and subscribe, and I'll be seeing you soon in the very next video. Bye bye, guys.